Oliver, founder of Myrmikan Capital. Welcome back to the show.
Well, thanks for having me again.
Well, last time you were on, you almost broke the internet with the statement you made here on the show of $3,000 gold, that you wouldn't be surprised if gold could get to that or higher.
Yep.
Now, we're having a good day today.
Yes.
So maybe we're on that road.
Finally.
But people love that statement. People, so that shows that people want to believe, they want to have faith.
It's not belief, it's not faith, it's monetary science. It will happen. When I first got in the gold business back in 2008, like many people, I was mugged by reality with the crash. I had no idea what was happening, what was going on. And I read a lot of books about money and credit written long ago. And my first analysis was completely wrong. Right? It was the Fed's going to print lots of money to bail the banks out. The more money they print, the less each one is worth, and gold will go up. That's the first level analysis. And the reason that's wrong is because the Fed doesn't really print money to give it to people. They add reserves to the banks. And the banks take those reserves and they go lend against assets. So it's not as if people have all of a sudden money in their pockets, are going to buy things, pushing prices up. It's actually the opposite. The banks lend money to people to build assets. You look around New York City here, where do you see cranes everywhere, right? It looks like Shanghai. And that's all over the world now, these low interest rates that the central banks have created, right? And when the bubble's happening, people don't need gold. You don't need gold when the market's going up, right? When all your investors are paying off. You need it when the opposite happens. And so gold always does badly during a bubble. And as I mentioned before, you can look back thousands of years, and you see this pattern again and again and again. Gold does not protect you in the credit inflation, it protects you in the crash.
What happens when we saw equity prices correct recently? A lot of people would argue gold did not go up and that it's acting less and less like a safe haven. What would you say?
Well, I would say look back at 2008, right? What happened in the initial crash? Gold got hit from 1,700 in just a few months, right? So you say, well, I didn't work, right? Well, okay, oil went down 80%, equities went down 50%. So what was really happening was the dollar was getting stronger. It wasn't that gold was doing it. Gold is the most stable substance anyone's ever discovered, the market's ever discovered. So prices move around gold. It's not really gold moving. So you got to look at what's happening to the dollar, demand, what's happening to copper, oil stocks, all those other things. That's the real story. It's not really gold.
So gold is the ultimate commodity for you?
The market shows gold as money because over thousands of years, gold's proved itself to be the most stable thing to be used as money. And this is well known in the 19th century. We've forgotten it this century.
So let me ask you, how does Dan Oliver see Bitcoin?
Well, that's a long conversation. I wrote a paper about it 2 years ago. Bitcoin's missing all kinds of things. Bitcoin's unstable. That's the problem. It's not stable. See, gold, what happens is when gold prices, when the gold price goes too high, what happens is that you get marginal mines coming into production, right? And people sell their jewelry, cash for gold. So supply comes to the market and lowers gold prices. When gold price goes too low, mines close, right? People go buy jewelry. And so there's a natural tendency for gold prices to be stable. There's nothing. Bitcoin's not connected to anything. You can't go wear Bitcoin around your neck, right? The Bitcoin miners, it happens on an automatic cycle. They produce X amount every 10 minutes.
So it's just too much volatility for you, too much risk?
So the nature of market money is to get rid of volatility. And the point I make on this is, if you look at oil prices since 1971, since Nixon took us off the gold standard, the monthly volatility on a 12-month rolling basis, the yearly volatility, is 64%. When you look at oil in gold terms, it's 40%. So gold shrinks the volatility. But I want to get back to your question, why gold is going to 3,000, right? And that has to do with what the nature of money is. I was just talking to Larry Parks. What is a dollar, right? A dollar originally was defined as a certain amount of silver and then a certain amount of gold. And now, what a dollar is in its essence is a unit of liability of the Federal Reserve. That's what it is. And so you say, okay, well, what are the assets of the Federal Reserve? And what are the assets? 30-year government bonds, right, at ridiculously slow rates, of a Congress that is wildly insolvent, that runs an enormous deficit, that has very little market value, and mortgage-backed securities. Those are the assets backing the dollar. And the reason they haven't collapsed yet is because the dollar also has a short squeeze going on. There's $3.5 trillion of dollars. There's $90 trillion of dollar-denominated debt globally. Right? And so the demand to pay interest on that debt keeps the dollar elevated. But once that short squeeze breaks, what happens is the market will say, okay, what's backing that thing? What's backing the dollar? And the answer is things of very uncertain value. And that's when you get the big...
What time frame could we see this happening in? A decade? 5 years?
If you look back at currency collapses, where we have good data for a couple hundred years, they don't collapse slowly. Right? Often in hyperinflation. I'm not calling for hyperinflation. When you read about them, what happens? You go to bed on a Friday, a cup of coffee is $1. On Monday, it's $50. Right? It's this discontinuous event where all of a sudden the world radically changes. And this is the point about gold investments, gold, mining companies, all those things. It's very tempting to say, you know what? Hey, I'll wait till it starts happening. I'll have my money somewhere else, and when I'll jump in. And the problem with that analysis is when it happens so fast. There's no time to get in.
Speaking of mining stocks, you refused to give me a name last time, and I had so many people write in, like, why didn't he just give you a name?
Lawyers. Those dastardly lawyers.
No, all the fans were revolting against you, Dan. Now, I'm not going to ask you for a name, and no, you're not going to give a name. That's fine. But are you buying right now?
Yes, I think that the miners, the miners have reached, as I said last time, the reason you buy junior gold mining stocks is because they can give you that potential for 20, 30, 40x, right? That insurance policy outcome.
But this sector has just been beaten down.
That's the point. That's how you get the values, right? Don't buy the top. The gold mining stocks are incredibly volatile. They're counter-cyclical. That's what makes them great, right? When the credit market blows up, they're going to go crazy, and you have to buy them when things are wrong. When you buy a stock, everything's going right. Okay, that's not the right time to buy. That's when they're expensive. You got to buy them when they're cheap, when they've got problems. That's what makes them cheap. That's what makes them.
Okay, how are you picking the winners then?
For me, the key thing is I want them to be cheap, but I want to have companies that have enough support or cash or something that they can withstand a drawdown, right? In other words, I think gold is going to 3,000. I think it's going above that, actually. If you look at the Fed's balance sheet, you can justify much higher prices than that. But that doesn't mean gold can't visit $1,000 first, temporarily, as it did in 2008, right? So you don't want a company that has a lot of debt.
So who's doing a good job at this?
Companies that don't have debt due in the near term, or that are all equity, right? If you're all equity, it doesn't matter.
Always a pleasure. Thank you so much for joining us.
Thanks for having me.
One day. Well, I'll just sign up for your newsletter.
Well, it's free. The price is right. The price is right.
All right. I'll go get that right now. Dan Oliver, thank you so much.
Thanks for having me.